Most people look at silver's price chart and see noise, green days, red days, spikes that fade, drops that reverse. They focus on the number. And because they focus on the number, they completely miss what the number is actually telling them. Because right now, underneath the daily price action, something structural is happening in the silver market. And if you understand it, the volatility stops being terrifying and starts being informative. That is what this video is about. Let me start with something that sounds like a paradox. Silver is simultaneously one of the most manipulated markets in the world and one of the most compelling fundamental setups in the market right now. Those two things are not contradictions. They are actually connected. And once you see how they connect, you will understand why silver keeps getting knocked down at key levels and why that pattern may be approaching an inflection point. Here's the first thing you need to understand. Silver has two markets running in parallel. There is the paper market, futures contracts, ETFs, derivatives, where enormous volumes of metal change hands on paper, most of which will never result in physical delivery. And there is the physical market, the actual metal, the coins, the bars, the industrial rolls of refined silver that manufacturers and sovereign buyers and institutions actually take possession of. These two markets are supposed to track each other, but they do not always. And when they diverge, that divergence is the signal. In physical markets, particularly in Asia, buyers have reportedly been paying several dollars per ounce above the official spot price just to secure actual metal. Think carefully about what that means. If silver were abundant, if supply were comfortable, no one would pay a premium. You pay above spot when you are worried about availability. You pay above spot when you need the metal in hand and you cannot wait for the paper market to catch up to reality. That behavior is a signal the chart cannot show you. At the same time, the paper market has seen concentrated short positions, a small number of large institutions holding short exposure that is disproportionately large relative to the size of the actual physical market. This is not speculation. This is documented. Major banks, including JPMorgan, have paid hundreds of millions. In JPMorgan's case, $920 million in a 2020 CFTC settlement for manipulating precious metals markets through spoofing and layering, placing large fake orders to move price, then canceling them before execution. These practices were admitted to, traders were convicted, settlements were paid, and yet the game continues just with a slightly updated playbook. So when silver gets hit hard at a key price level, when it approaches resistance and suddenly drops 3 or 4% in a low liquidity session, the question worth asking is not, was I wrong about silver? The question is, do the physical signals confirm this paper weakness? Because more often than not, they do not. More often than not, the metal stays tight in the real world while the paper market creates the appearance of abundant supply. Why does this matter right now? Because the macro environment is shifting in ways that make this dynamic harder to sustain. The dollar has been under pressure. The Federal Reserve is facing a genuine dilemma. Economic data has reportedly shown slowing growth while inflation remains elevated, creating a policy environment where both raising rates and cutting rates carry real risk. When the market starts pricing in future rate cuts, something important happens to gold and silver. The opportunity cost of holding them falls. The argument that I could earn 5% in a treasury bond weakens, and capital that was sitting in yield-bearing instruments starts looking for alternatives. Gold and silver have held value across thousands of years, across dozens of currency collapses, across wars and defaults and devaluations. They do not pay interest. They do not pay dividends. They just exist. And in an environment where the reliability of currency is being questioned, where trade policy is unpredictable, where geopolitical uncertainty is elevated, where debt levels at every level of government are structurally problematic, that simple existence becomes valuable. There is also a supply dynamic that most people underestimate. Approximately 70 to 80% of silver supply comes not from silver mines, but as a byproduct of mining other metals, copper, gold, lead, zinc. That means silver supply is not primarily driven by silver economics. When those other metals see reduced mining activity, silver supply contracts too, regardless of silver's price. Meanwhile, industrial demand for silver is growing. Solar panels, electronics, medical devices, defense systems. Silver is not going away from industry. It is becoming more essential to it. Growing demand, constrained supply, physical premiums. Documented market manipulation that has legal limits. A macro environment that is tilting toward weaker real yields. That is the structural setup. Now, here's the part that the gold-silver ratio makes even more striking. Historically, the ratio between gold's price and silver's price has averaged somewhere around 50 to 60 ounces of silver to buy 1 ounce of gold. For much of the past several years, that ratio has been elevated above 80, sometimes approaching 90 or higher. What that means in plain terms is that silver is historically cheap relative to gold. If that ratio reverts even partially toward historical norms, silver's upside from current levels is significant, and that is before accounting for any additional bullish catalysts. So why has silver not already moved? This is the uncomfortable part, and I want you to sit with it. Silver does not move smoothly. It does not reward people who need constant confirmation that they are right. It is volatile by nature, and that volatility is amplified by the concentrated short positions we discussed. The result is a market that regularly shakes out impatient holders right before major moves. The mechanics work like this. Silver starts moving higher, retail attention increases, leverage gets applied, futures contracts, leveraged ETFs, options. Everyone is calculating their target price and what their account will look like when the thesis plays out. Then the exchange raises margin requirements on futures contracts, not unusual in volatile markets, but deeply inconvenient if you are leveraged. Suddenly your position requires more capital to hold. If you do not have that capital available, you do not get to choose whether to hold. You get liquidated. That forced selling pushes price lower, which triggers more margin calls, which causes more forced selling. It cascades. By the time it ends, the leverage players are out of the trade, often at a loss, and the price recovers, sometimes within days. The people who got liquidated were not wrong about the direction. They were wrong about the structure of how they held the position. That is the difference between being right and making money. So here is the framework, not for trading silver, but for thinking about it clearly. The first distinction is between the paper signal and the physical signal. Price is a paper signal. Premiums, lease rates, and backwardation. When spot silver trades above futures, signaling urgency to own metal now rather than later, these are physical signals. When price falls but physical signals stay firm, the dip is more likely a shakeout than a fundamental change. When both price and physical signals confirm a move, the move is more likely real. The second distinction is between trading it and holding it. If you are trading short timeframes, volatility requires stops, position sizing, and discipline. You cannot let a trade become a prayer. If you are holding for the long term, you accept the drawdowns as part of the ride and anchor your decisions to the fundamentals rather than the daily chart. The mistake most retail investors make is starting as a long-term holder and then watching the screen too closely until they start behaving like a short-term trader, getting whipped in both directions until they finally sell in frustration, usually right before the next leg higher. The third principle is the one nobody wants to hear. Timing is not knowable. No one can tell you whether silver's next major move is months away or years away. What is knowable is the structural setup, the supply constraints, the documented manipulation, the physical market signals, the macro tailwinds. If that setup is sound, the question is not whether it plays out, but whether you are positioned to benefit when it does, without getting destroyed by volatility along the way. That means avoiding leverage unless you have deep enough capital reserves to handle unexpected margin increases. It means not betting money you cannot afford to lose. It means understanding that you can have the right thesis, the right analysis, the right conviction, and still lose money if the execution is wrong. This is actually the core insight that most financial content refuses to address honestly. Being right about an asset is a necessary condition for making money. It is not a sufficient one. The market does not care about your thesis. It cares about your exposure, your time horizon, and your ability to stay solvent long enough for the thesis to play out. The wealth building reality here is not glamorous. It is understand the structural setup, size your position to what you can hold through a 40% drawdown without flinching, watch physical signals rather than paper price for confirmation, avoid leverage, and let time do the work. Silver has been one of the most consistently undervalued assets relative to its industrial role and its monetary history. The gold-silver ratio suggests it remains historically cheap relative to gold. The supply dynamics are structurally constrained. The manipulation has legal and financial limits, and the macro environment is shifting in directions that have historically been tailwinds for precious metals. None of that guarantees a specific price by a specific date. Anyone who tells you otherwise is selling something. What it does suggest is that the structural case for silver is as well supported as it has been in years, and that the volatility designed to shake you out is, in many ways, the price of admission. One question worth sitting with. How much of your financial thinking is driven by price watching versus structural analysis? Drop your honest answer in the comments because the answer to that question probably explains more about your financial outcomes than any single investment decision you have made. See you in the next video.